Hello and welcome to Lesson 1, Income Tax Fundamentals. By the end of Lesson 1, students should be able to describe how the system of federal taxation has changed over time, identify 3 separate federal tax systems that impact tax planning decisions, list and explain the 2 general rules of income taxation, describe why characterization of income is so important, and define the 3 tax principles. Now, not so long ago, a prominent politician made headlines by declaring that more than half of U.S. citizens had not paid income taxes in the previous year. While this is technically a true statement, it is very difficult for a U.S. citizen, and in fact a resident of the United States, to avoid paying payroll taxes, property taxes, or the ubiquitous sales tax. In fact, it was after the Civil War and in fact the 20th century when income tax became prevalent. Before then, non-income based taxes were used to raise revenue. The Form 1040 was introduced in 1913 as a tool to calculate the personal income tax liability. Over the years, the top marginal tax bracket has varied and reached 94% during World War II. Since then, it's dropped down, and the current top individual marginal income tax rate is 39.6%. Today we're going to talk about some general rules. We'll have an overview of the federal tax system. But it's important that to remember that although we are learning general rules, we need to watch out for the exceptions. And in fact, there are often exceptions to the exceptions, as you will certainly learn and observe over and over again over the next 8 weeks. We're also going to focus on one of the 3 tax systems in this class. There are in fact 3 tax systems: the income tax system, which is the focus of this class, the estate and gift tax system, and the generation skipping transfer tax system. Now, these are 3 separate and distinct tax systems. Sometimes they overlap and sometimes they parallel each other. Sometimes they contradict each other. But we will be focusing on the income tax system in this class. Now let's start with a couple of basic rules of income taxation. Generally speaking, all increases to wealth from whatever source derived constitute income. And for every deduction taken for income tax purposes, there must be an offsetting inclusion amount. So first, let's talk about increases in wealth. This is more than just an increase in cash. Think about that personal balance sheet from your other financial planning courses. When there's a net increase in wealth, in theory, income should be realized in the tax system. However, there are a couple of caveats. First, income must be measurable and realized to be taxable. And secondly, and more troublingly, what we'll spend more of our time on, other exclusions specifically listed in the tax code promote public policy. For instance, life insurance proceeds. If someone receives life insurance proceeds, that certainly is an increase in wealth, but the tax code has specifically excluded that from income for public policy reasons. The second principle talks about the concept of matching. When someone picks up income, someone has a deduction, and vice versa. We can see this with employers and employees. Employers deduct wages, but that means employees have to include wages and income. Similarly, when alimony is paid, someone gets that deduction, but the recipient must include that alimony in income. And of course, as we just mentioned, there are exceptions to the matching principle, and they include charitable contributions. I get a deduction for making a charitable contribution, but the charity does not pay income tax on that. And retirement plan contributions. Again, that's an exception that Congress has carved out to promote saving for retirement. Now, throughout this course, we'll learn about various triads of income, or triads of income tax principles. So the first triad we're going to learn about are the 3 types of income: active, passive, and portfolio. In later weeks, we'll learn how important it is to characterize income into one of these 3 baskets, and how classification is very important as it impacts deductions and losses that are allowed, as well as the rate at which income is taxed. There are also 3 methods of tax accounting that we will learn about. The first is the cash method, which is used by most taxpayers and small businesses, and that means as cash is received, it's recognized in income. As expenses are paid, it is recognized as an expense. In contrast, the accrual basis of accounting is used by larger businesses, and it recognizes income when earned and expenses when incurred, not necessarily when received and paid. And then the hybrid method is neither cash nor accrual. It's, as the name suggests, a hybrid of the two. And the most common example of a hybrid method of accounting is a small business owner that has inventory. And so for most items of income and expense, they are on the cash basis. But when it comes to accounting for that inventory, they are using more of an accrual basis. And so that cash and accrual hybrid makes that the hybrid method. There are 3 key principles of income taxation, known as constructive receipt, which means if income is available to me, it should be taxed as income. The economic benefit doctrine, if I receive value, even if it's not in the form of cash, that should be considered income to me. And the fruit of the tree doctrine. The fruit of the tree doctrine suggests that if I own an asset and I receive income from it, I must be the one to pay taxes on it. If I own an asset, I can't assign that to another taxpayer, to a sibling, to a parent, to a child that has a lower income tax bracket, income tax rate. I must keep that income for myself. Financial advisors have 3 common methods of tax planning. There's legal avoidance, there's maximizing deductions and credits, and there's deferral of income. And we will learn about all 3 types of methods to minimize income taxes over the taxpayer's complete time horizon, not just 1 year at a time. And all 3 are equally effective in helping to minimize a client's income tax liability. It's still common among many taxpayers to believe that it is possible for wealthy people not to pay income taxes. While that may have been true in the past, it is very difficult today for someone who earns a lot of money, who really has a lot of economic increase in wealth, to avoid paying income taxes. And that's thanks to 3 anti-abuse provisions in the tax law. The first is alternative minimum tax. The second are the at-risk limitations. And the third are the passive activity rules. Now, each of these anti-abuse provisions is pretty complicated, and in fact, we'll be spending considerable time on each one in future weeks. But for today, just know that it is very difficult for people who earn income, whether they earn a lot of income or not so much income, to avoid paying income taxes altogether. Anti-abuse provisions are pretty effective now. So to summarize, today we discussed how the system of federal taxation has changed over time. We've identified 3 separate federal tax systems that impact tax planning decisions. We learned the 2 general rules of income taxation. We learned why characterization of income is so important, and we defined some key tax principles.